Hi, everybody. Today we're going to be talking to you about Williams-Sonoma and giving you a stock pitch. My name's Avery Bundy.
I'm Madeline Smith.
I'm Brett Sawyer.
Today we're going to be talking to you guys about 6 different sections: the stock summary, company background, investment thesis, catalyst, valuation, and risk, all for Williams-Sonoma. So let's start with the stock summary. So these are our values that we calculated. So when it comes to the stock of Williams-Sonoma, we believe that it is in your best interest to be a bear. We believe that the price per share of Williams-Sonoma is inflated beyond the true value of the stock due to a higher influx of sales resulting from the coronavirus pandemic. As evident from the price per share and the target price for our data on March 11th, 2021, we believe that this stock has a percent downside equivalent to 22.95%, and therefore interested individuals should use a short stock position for investing. This information is then supported by our calculated PE ratio because the valuation of 29.62 is considered high and therefore shows that the value of the stock is overrated. To further that assumption, when accounting for growth rates, we calculated the PEG ratio. Here, the value of 2.64 is also considered to be high, thus showing again that the stock is overvalued. So next, let's talk about some values to further our assumption. So these values were acquired by marketbeat.com, also about Williams-Sonoma. So furthermore, in continuing support for our earlier assumption, similar data from the members of marketbeat.com was collected April 7th, 2021, that suggests the stock of Williams-Sonoma continued to rise since our prior calculations. However, this data also suggests the stock is overpriced and that it will fall in the coming months, which is seen by their percent downside, their PE ratio, and their PEG ratio. So therefore, moving forward, we believe it is in the best interest to use the bear strategy of shorting the stock because we predict the value of Williams-Sonoma is going to fall.
I'm going to talk about some company background, financial statement insight, and some trends in the industry. So Williams-Sonoma is in the retail sector. They specialize in fine home furnishings, homeware, and decor. They currently operate through over 600 brick and mortar stores, including its popular subsidiaries, such as Pottery Barn and West Elm. Although they have stores all over the US and within other countries, they still see over 50% of their sales volumes from their online website and actually contributing to about 56% of total revenues. Like other retailers, Williams-Sonoma is realigning resources and investing more into their higher performing and higher margin stores and closing those who have smaller profit margins to mitigate the high overhead costs. Since 2019, they have made it onto the Fortune 500 list. So here is some insight to their financial statements for 2020. All figures have been up to 2019 results, with a total net earnings up 6.3% to 2019. So for some trends, retail has seen the highest sales volumes in 2019, and it still continues to grow. I think that we'll see that COVID did have a minor effect on these volumes throughout the industry, but will easily bounce back. The industry has seen over 50% of all sales coming from online transactions, just like Williams-Sonoma. And again, like Williams-Sonoma, the entire retail sector is experiencing the need to reallocate resources to higher performing stores.
I will give our investment thesis. We see Williams-Sonoma as a short with around a 23% downside. The price is inflated by unsustainable growth caused by the pandemic and their success during the pandemic. Williams-Sonoma was able to move the majority of their sales to online, which is a positive for future growth, and we believe this is the reason for the continued investments in Williams-Sonoma. The profits they show, however, just nowhere near justify the stock price, even with the positive business improvements.
And I'll also be talking about catalysts. So catalysts are some of the things that we foresee having an effect on Williams-Sonoma in the short term and long term. So the biggest one is that Williams-Sonoma is growing at a rate that is not sustainable. The stock price is over 150% of the normal range and still continues to climb. Like other retailer stocks now, they are eventually going to hit a peak and will fall rather quickly back to their normal range of share price. Another one, the unemployment and stimulus payments are along the same lines. These payments are going to decrease and diminish, leaving fewer individuals with the additional disposable income that these two things provide. The most positive one, like Brett mentioned, the online transition, though, is a major positive. Williams-Sonoma has an advantage when selling online. A lot of the retail sector includes clothing, which consumers like to feel, touch, or try on. And it's very easy for our company, Williams-Sonoma, to sell to the customer with photos rather than needing to see it in a store. So we expect online sales to continue to grow.
Now I'm going to talk about valuation. So for Williams-Sonoma, because we are going to short, we decided to give you a relative valuation, which is where we're going to compare companies across the same industry. So when comparing the numbers of Williams-Sonoma and their industry competitors within the consumer cyclical sector, an individual can see that Williams-Sonoma is a worthy contender. While Wayfair tends to dominate this industry with the current share per price, the equations associated with Williams-Sonoma are comparable. The average EV to EBITDA for this industry competitors is 10.44 respectively. This means that all of these companies being compared are overvalued based off of these formulas. The average PE ratio for this industry is 24.65, again showing that all of these companies are overvalued based off of this formula. Yet when looking at the PE ratio, growth is not accounted for. Thus, we compare the PEG ratios here to account for the industry growth. Unfortunately, Kirkland and Wayfair didn't have this ratio accounted for. But we were able to compare Fortune Brands and Williams-Sonoma. Here we can also see that they are also overvalued using this ratio. This is evident because a good PE ratio is considered to be under 1, and both companies' ratios are over that limit. We believe that the reason that these ratios are overvalued is due to the demand of the industry, or due to increased demand because of the coronavirus. After this outbreak, this industry's value soared as individuals were forced to remain at home, thus leading to the stock's value soaring and causing Williams-Sonoma and their competitors to be overvalued. Therefore, we believe that it would be in a consumer's best interest to short any stock within the same industry as Williams-Sonoma because they are overvalued and the price of the stock will eventually fall.
And finally, I'll be talking about risks as well. So we think the most influential risk for Williams-Sonoma is going to be the change in consumer spending behaviors. With the COVID-19 pandemic, families were spending more time in their homes, and home furnishing retailers started to see sales skyrocket from people investing in home furnishings and decor. Also, interest rates for mortgages are at historic lows, and homes are selling within hours. So more households are in need of products for their homes. We expect this behavior is going to change, and the company is going to see decreases in sales. Another risk we found is business executive decisions. So about a year ago, in April of 2020, Williams-Sonoma was forced to pay $1 million to the Federal Trade Commission for misleading and false advertising of products being made in the United States. It's very often that consumers will spend a little bit more on a product if they know it's made in the US. So they made the decision to market these products and lost trust of consumers and investors. And the last risk is brand recognition. And what we mean by this is a lot of young or uneducated investors are more likely to invest in companies that they recognize or shop with. Like what we saw with GameStop not too long ago, investors drove up the price and more bought into it because they were familiar with the company. This drove up the price and it eventually plummeted.
Guys, so these are our references that we used And if you have, I really hope you like the presentation. If you have any other like further questions, just let us know.
Thank you.
Thank you.